meeting. I will hand it over to Chair for introductions.
Good morning, everyone. Rosemary Tabellas, designee for Police Commissioner Bratton.
Barry Dennis, SIS, consultant to the fund.
Dan Torelli, PBA.
Joe Alejandro, PBA.
Joe Rayo, PBA.
Chris McGrath, PBA.
Bob Ganley, SBA.
Lou Turco, LBA.
Chris Monahan, designee for Roy Richter, CEA.
Michael Palladino, DEA.
Neil Messing, Comptroller's Office.
Yvonne Nelson, Controller's Office.
Sherry Shan, City Actuary.
John Dosa, alternate designee for Controller Stringer.
John Mercerberg, Controller's Office.
Scott Evans, Controller's Office.
Susanna Vickers, designee for Controller Stringer.
John Adler, designee for Mayor de Blasio.
Antonio Rodriguez, designee for Finance Commissioner Jack Jiha.
Bob Senskis, Stat Pension Fund by invitation.
Tatiana Pohotsky, the Comptroller's Office.
Alex Donier, Comptroller's Office.
Penny Bolova, Controller's Office.
Brian Cook, Controller's Office.
Chris Pop, Controller's Office.
Lauren Kroll, Controller's Office.
Michael Garland, Controller's Office.
Scott Ferguson, Controller's Office. Christopher Minor, Pension Fund by
What's that?
invitation.
Nicole Giambrisi, Police Pension Fund, present by invitation.
Mark Gazelle, SIS, consultant to the fund.
Margaret Scala, SIS consultant.
Just before we continue, I just want to make sure we're clear on the record. For purposes of this meeting, I'm the designee for Patrick Lynch and John Puglisi. Dan Torelli will be the alternate proxy for, has the proxy for Mubarak Abdul-Jabbar, and Alice Serno's proxy will be given to Joe Rayo.
And for the record, I am the proxy for Ed Mullins, SBA President.
And we should just note for the record that all those that went around the table that did not indicate that they had designees or alternates are here by invitation of the fund.
Thank you.
Okay,
That's nice to be one. Okay, Scott.
this agenda earlier this week took us till 4 p.m. At the fire department, and I'm told by several in the lobby that is not acceptable, that police intend to do this faster.
Police tend to be a little more efficient than what they do, so we'll do this very quickly.
And we in the Controller's Office, by invitation, will do our best to
Live up to that stuff.
move this along.
Well, not in the Controller's Office, be fire, right?
Okay, so we'll start with the new quarterly report that is entitled Total Fund Overview. This is the public document, and if we turn to page 17, we can see the new report, which includes fees against the gross returns, both for the total fund and in all asset classes. I'm going to go through it, and then each of the managers will quickly go through their asset classes. But as you can see, on the top of line 6, all the way over on the left gives you the line number. The total portfolio at the end of June was $33.2 billion. And if you go over 2 rows to the fiscal year to date, this is the full fiscal year ending June of 2015. The gross return is 4.09%, and that's the return that we had been showing. It's gross of public and net of most private fees. And what we've done is to net out the public fees, in this case 13 basis points. And then we also have 11 basis points of private fees where we have the specific identification. We'll talk more in the executive session, but the challenge for us now in all of the partnerships is to increase the detail that we're getting from our GP partners so that we can break out the fees that are being charged and put them into this, and we'll get a comprehensive list. When we get those additional ones, we'll be adding to the gross and to the expense, so the net numbers should be unchanged, but we'll get better definition.
Scott, what's the hold up or the complication with regards to getting the fees? Is it the bank? Is it the partners? Is it what's the difficulty in the pipeline?
To put it as cleanly as I can, the invoicing standards that the GPs use are different from one another. And so when they come to the accounting department, a lot of them just give the net numbers. And so what's inputted is the net numbers. What we need is for the managers to break out base fees from carried interest fees, from fee offsets, et cetera. The industry's been wrestling with this. There's been a lot in the paper on CalPERS and others. We've talked to CalPERS and other major funds. And the Limited Partners Association, ILPA, put out a standard for the capital call and distribution notice, or the invoice that the managers send. And that standard would break out all these things. And we're in the process of imposing that standard on all our managers going forward. CalPERS has been able to get a very high percentage of people to move to the standard, and we intend to try to get all our managers to move to it. As they move to the standard, we begin to be able to detail the information here. So this it's 11 basis points in the case of blues. 11 basis points of alternative markets is incomplete. They're already deducted from the returns on the net returns on the bottom. We just haven't been able to break them out. So when we get the new ones in, so if we were to get a new invoice in, there'd be more gross return by the same amount of the extra expense. We'd just be able to detail the expense. So it's just getting more detail on the information. But you're now looking at net returns versus benchmark, so we can see, how did we do after we pay the managers relative to the benchmarks that we use, and that's in fiscal year to date, 49 basis points less. 3 months, the last quarter of the year, 19 basis points better. So when we have the fee information for the time period, the net is being shown in either green or red. When we're still looking at gross fees, as we are with the older historical data, we put it in black. Either no parentheses if it's positive, and a parentheses if it's negative. So as you look down all the reports, we'll use that same methodology, and you can tell if it's green or red. You're looking at net of fees results.
Okay, so the ILPA report that you refer to, it's something that we're looking to make our managers adhere to?
Correct.
Then could you do me a favor and just send that report out to all the trustees so that at least we have
Sure.
it?
So you
it's
can
a
see what the
standard that we
standard is.
know
Yeah.
that that's what our managers are being held to.
Yeah, I'd be happy to. It was something that the industry did through ILPA several years ago, and after a lot of discussions, the major players I think have all gravitated towards this.
No, it sounds good, and
we'll be happy
I'd like
to
to
send
make
it.
sure that
Yeah.
At least I'm familiar somewhat.
Absolutely.
With it. I think all the other trustees should be familiar.
We'll be sure to do that, Jim. Okay, so that gives you a look at what the net results were, and you can see then for each of the asset classes how we're doing, and I'll let the managers, asset leaders do that. I'm going to move to page 10 quickly so we can have a closer look at the quarter, and we can see that the quarter was 19 basis points ahead of the benchmark. Most of that came from selection as opposed to asset allocation among asset classes. And on page 13, we can see where that asset allocation was affecting the portfolio. So for instance, in structured bonds, we gained 5%, and in emerging markets, we were under by 4%. And in allocation, if you look down where most of the action was in selection, you can see that domestic equity, the total was 18, private equity was up 24 basis points, and the structured was down. This is the selection within the group that you're familiar with looking at. Now we have it on a net basis. Okay, with that, why don't I turn it over to John Merseburg to begin to take you through the asset class detail.
Thank you, Scott. If you would please turn to page 20 of the report. I'll be brief since the report was distributed in advance. The first section on the top of page 20 shows the performance of the U.S. equity composite, and the composite had net returns of 1/10 of a basis point for the quarter and 6.9% for the fiscal year. And this trailed the benchmark by 4 basis points for the quarter and 39 basis points for the fiscal year. If anybody has any questions about specific managers, I'd ask that you hold those for the executive session. And then turning to page 21, the third composite on the page, beginning with line 302, shows the totals of belt composite, and that was ahead of both the EFA and the EFI IMI indexes for both the quarter and the fiscal year. And the EFI IMI is a broader index that adds small cap companies to the EFA index. Police had added some small cap managers back in May of 2013, and then some passive allocation in February of 2014. So for the more recent trailing periods, the EFA IMI is a better overall index, while the more distant years are best judged by the straight EFA index. And then turning to page 22, the fourth composite down, beginning on line 398, shows the total emerging markets composite. And this composite was ahead of the benchmark by 16 basis points for the quarter, but trailed by 104 basis points for the fiscal year. And this was driven by the performance of the active managers. Does anybody have any questions about the public equity summary in the report? If not, I'll hand it over to Robert Feng to talk about the fixed income.
Great. Good morning. I'd like to start off with page 24, line 478. So we'll first look at the structure of the core fixed income program, which is about half the entire fixed income allocation. The excess return has been close to flat for the fiscal year, and for the quarter we outperformed. We outperformed due to our overweight in mortgages and credit and our underweight in treasuries. Line 508, we can take a look at TIPS, which is close to 3% of the overall police fund and about 8.5% of the fixed income allocation. With 3/4 of our assets in the passive index, we're pretty flat to the benchmark. Line 518 is our high yield performance. Our high yield weighting is about 4% of the overall fund and 12% of the fixed income portion. Our high yield underperformance is due mainly to energy, metals, and mining. Metal and mining companies continue to experience declining prices due to a slowdown in global demand and weak energy prices. Next, we'll go to line 528. We'll look at the bank loan sector. Bank loan sector is about 1.7% of the fund and 5% of our overall fixed income allocation. A big benefit was the credit selection in the single B space, which overall did better in the second quarter. And then lastly, we'll go to convertibles on line 538. Convertibles about 2% of the overall fixed income allocation, about 70 basis points of the fund. And we have a manager there who tends to underperform when equities are having a positive quarter. So if there are any other questions, if not, I'll hand it to Wes.
But before you go on, I know you've lost Martin Gann's staff. I don't know if it's permanent or not. I assume it is. I'm not sure.
Right. I was going to talk about the staff in executive session, if that's okay. But be happy. I will.
I just want to know who's going to be on your staff handling that area.
Yep.
If Martin is watching, since we are on the record, I want to say I can't say more about him other than he was very knowledgeable, insightful, professional. I had great respect for Martin Gans. If he chooses not to come back, it will be a loss. I hope once in a while he'll check in with us and let us know that we're on the right track or off to the wrong track. But I had great respect for Martin's opinion on things. So.
Thanks, Joe. I just to clarify, Martin has retired, and as you know, and Wesley is the acting head of opportunistic fixed income, and Robert Feng, who you just heard from, is the acting head of public fixed income, and I'll speak a little bit more about that during the executive session.
And I'd like to say that there's a very good chance that Martin is watching right now.
and Martin, if you are watching, turn this off and go have some fun.
But you're saying this is not fun?
All right, so page 19, please, for a quick overview of the opportunistic fixed income portfolio. It's line 180 there on top. Opportunistic fixed income represents 2.56% of your AUM, about $851 million. For the quarter ending June 30th, the portfolio underperformed by 172 basis points. This is primarily due to exposure to the energy sector. But inception to date, we still have strong performance of 9.26 versus the 10% benchmark. So that's still underperforming, but still quite strong given what's happened recently in the energy sector. If there aren't any questions, I will move it on to Neil?
Brian.
Oh, Brian Cook, of course.
It's okay. The last bit of fixed income. So on page 19, line 190, we have the total ETI portfolio line. As you can see, this was a harder quarter for us. We were underperformed our benchmark by 147 basis points over the quarter, and over the last 12 months, underperformed by 92 basis points over the last year. This is primarily due to the valuation of our long-term loan programs and the interest rate risks that I've been talking about. To give context, in July, if you were to look at the public book, you'd see we're actually up 3.18% in the last 3 months and 2.34% over the last the year to date in July. So we've completely remade back those losses because it's just about the value of the loans. To give you the sort of top line of what happened in the PPAR program, it underperformed its benchmark by 3.9% and in the second quarter and 3.78% over the last 12 months. It is now back up to 5.14 and 5.12% in the positive respectively. So there's a huge difference that the month makes in the valuation on the interest rate. I'm happy to go through the numbers in a comparison in executive session since some of the materials are in non-public books. And then to give you just sort of a sense on the collateral benefits rather than walk you through everything, pages 8 through 12 of this big book goes through all the collateral benefits that we accrued over the year. Access RBC and AFLO CIO hit, while they both outperformed their benchmark, didn't make any new loans. In PPAR over the last quarter, the police pension actually created or preserved 556 units over the last quarter and set forward rate locks for another about 1,500 units. And that's the top line, except for I'd like to make one announcement. Kali Ndoye has left us. She used to run our PPAR program to become a beneficiary and pursue her mission of actually doing some good in Africa. So we have with us Lauren Crowell. And since we run this program for you, we wanted to specifically introduce our new staff who are running it. She comes to us from Domain Companies with 6 years experience helping actually do compliance work on affordable housing, on wage standards, as well as getting deals done. So it's a new skill set as well as, and I can always say a very productive working relationship. Are there no other questions?
Brian actually did have one question.
Sure.
So every month we have to kind of talk about essentially that, while we have to report, kind of the market value of our book, particularly for our buy and hold, portion of the program, that, really, it's the cost, like we've been up and so now we're going to be down because, of the changes in the rates. Are there any other kind of performance metrics that we should kind of look at? Obviously the collateral benefits, but like a loss ratio of some type that'll give us a sense of, since this is a buy and hold portion of the program, that's what we really care about, right?
Sure. So what I actually look at is the coupon rate. Your loss ratio is zero.
Pretty zero, all right.
Yeah, like these are 100% insured. You will not lose $1 on this program unless the state of New York goes under. In which case, you guys will all be worried about other things than whether or not.
Why do you have to be so nasty?
So what I look at is typically the coupon rate. While I can actually start working in a little bit more of this because we're actually working with our servicer to break out each system. It gets a little complicated for each loan because each loan gets weighted by the percentage that the board was in the PBAR program for when that loan was made. So we have basically 30 years worth of loans and percentages. I can tell you the sort of coupon rate right now for all 5 systems is about 5%. Yeah, it's actually a loan, give or take, give up to about 30 basis points. So right now, the true return you're getting on a year basis is sort of a guaranteed north of 5. But theoretically, we could sell the portfolio for these things, and that's what legally we have to present.
No, absolutely. Just want to think about other ways for us to look at it. Thank you.
Thank you. Okay, so turn over to.
Okay. So hedge funds is on page 17. We underperformed this quarter. It's a little disappointing because it's the first quarter that's happened since we've been in balance. But at the same time, we expect this to happen from time to time because we have a concentrated portfolio. Our portfolio is about 15 investments. The index itself is a couple hundred, and so the timing hurts because it affected the fiscal year to date and so far calendar year to date. But that's performance for the last quarter. If there's any questions, I'll take them. If not, I will pass it on to Alex for private equity.
Thanks, Neil. And I'll be working very quickly off of the big agenda book on page 26. Second column from the left. And as private equity reports on a lag, we will be discussing private equity performance for the police portfolio as of March 31st, 2015. You will see that the market value in private equity for police was $2.3 billion. In addition, unfunded commitments totaled $1.2 billion, resulting in total exposure to private equity of $3.5 billion. You'll see there at the top of that column, the March column, that police had $4.2 billion in active commitments across 104 managers and 167 funds. If you look at the bottom of that page, you'll see the performance to date since inception on a net basis, which is 10.6% IRR and a 1.39 times total value multiple since inception net returns. I'll quickly ask you to turn to page 28.
Alex, before you
Yes.
continue, you notice from December 14 to March 2015, there was only the number of investments have gone up. Where are we with the pipeline that we had approved? Where are we with the pipeline, and how many investments did we do this year so far?
Okay, so I can flip you to that. If you flip to page 25, we can show you what the activity and quarterly highlights. If you look under middle of the page, new investments, you will see that in the quarter, there were 2 investments made to the total of $52 million. But subsequent to the quarter, to your specific question, police has deployed $154 million to 5 managers, and the pipeline is robust.
Okay, good. I want to make sure we're putting our money to work.
Yes, we are. And then lastly, I'll take you to page 28, where there's a little more detail on performance, and we show you performance across different time horizons. Certainly, as we always mention, for private equity, given the long-dated nature of the asset class, we believe the 10-year and certainly the since inception are the best measures of the performance of the portfolio. So once again, you'll see that the portfolio is delivering 10.6% net IRR since inception, which relative to the benchmark, which is the Russell 3000 plus 300 basis points, is a lagging by 260 basis points. I'll quickly point you to the bottom of the page because you will see where the returns are being paced by, and 3 important highlights. If you look at your returns, they're being led by strong performance in large buyout, If you go to the far right-hand column, IRR, you'll see large buyouts delivering 25% net. Those will be names like Apollo, CVC, and Vista. You then have secondaries generating 17% net returns since inception. Those are names like Ardian and Landmark. And then you also have growth equity with 14% net returns, and those will be funds such as Warburg Pincus. And with that, I'll take any questions. Thank you.
Thank you.
So moving on to real estate, I'm going to stay in the large board book. I'm going to skip the spiral, give you the highlights, and stick with page 43 to review first quarter 15 highlights for the police real estate portfolio. So the allocation for real assets, as you know, is 6%, which would bring the allocation to about $2 billion. In terms of your holdings in real estate, value of what we have in the ground today is about $1.3 billion, or 3.9% of your AUM. We have about $480 million in commitments that we have yet to fund. So our total exposure to real estate as of first quarter is $1.8 billion, or 5.4% of AUM. The portfolio is comprised of about 52 investments at this point, with 36 managers. As we turn to performance, this is a long-term asset class. We don't hit it out of the park every quarter. This particular quarter, the portfolio registered a return of 2.8% on a net basis compared to the benchmark at 3.4%. Underperformance of about 60 basis points. If you look out to the right on the graph at the bottom where the police portfolio is in the dark bar, you will see that for the 1, 3, and 5-year periods of the police portfolio outperformed this benchmark by at least 200 basis points. Overall, the program is performing well, and on an IRR basis, the net return since inception is 7.3% after fees with a 1.3 times multiple. If you turn to the next page, page 2, talks about how the portfolio is constructed in terms of strategies. We have a core strategy and a non-core strategy. In terms of the risk metrics for the program, we have an overweight right now to our non-core strategies at 66%. And we'll discuss that even further later in the program. But the overweight is something that we talked about immediately after the recovery. There was a huge dislocation in the market, a lot of mispricing, and we gave a lot of capital to managers who were able to take advantage of that. Created an overweight. It's something that we talked about in each annual plan since the recession. We are working our way out of it, and probably at its high point, the overweight was at 69%. So gradually and slowly, we're working that down. As you know, we've made some recent commitments to core plus managers that would bring that in balance, and I'll bring you a new deal in that strategy in private section. And so, again, the portfolio is well diversified, and we have some diversification charts on page 5 in terms of how the portfolio is diversified by property type and by geography. We are at this particular time close to 15% in terms of our ex-US exposure. And again, in closing, just a summary of how the program stands from a compliance perspective on page 7. And again, as I mentioned before, we'll talk a little bit more about the investment strategy diversification in executive session. Thank you.
Good morning. Moving on to infrastructure, page 56 of the big book. My comments will be very brief. Infrastructure is a relatively new program and relatively immature. As March, the infrastructure program has committed 160 million and contributed 28 million approximately, with a market value of 29 million. Looking at page 57, you would see how the performance compares relative to the benchmark. The benchmark is CPI plus 4, so it moves, it fluctuates with the level of inflation. For that, since inception, the program has generated 14.8% net return relative to a benchmark of 5.6% for that period. The results are very good, but again, it's very early in the program. Then in terms of geographic diversification, North America represents the biggest part of the program with 62%. Europe is around 38%. In terms of sectors, renewables represent approximately 52%, followed by transportation and energy with 17% and 16% respectively. And finally, on page 67, there is a risk management matrix which walks through the compliance with different parameters of the program. And one important parameter is leverage, which is much lower than allowed by the program. So it's a pretty good conservative metric so far. With this, I'll conclude my remarks, and anyone has questions. Thank you.
So that concludes our reports from the managers for the quarter. We'll briefly just cover the July results in the flip book here. If you turn to page 39, we can look at the totals. And just to orient us in terms of what we're looking at, if you look all the way on the bottom of page 39, you see $33.34 billion for the fund. And if you go all the way over to, let's see, 1, 2, 3, 4, 5, 6, 7 columns over is fiscal year end 6/30. It's the period we were just talking about. 409 was the top number before we deducted the expenses, and it's 409 we're looking at here. So this is the old gross and fees performance on the monthly basis. Flipping back to the third column from the left, we can look at the July quarter was up 38 basis points. A little behind the benchmark of 64 basis points.
July month.
So
You said July quarter.
I meant July month, right. It felt like a quarter. But
And then what did August feel?
August really felt like a quarter. So if we then flip to page 32, we can see the relative weights. Sticking with the same strategy that we've had for some time now, we're on policy for the most part across the equity exposures, emerging markets popping down a little bit with the underperformance during the period. That exacerbated a bit in August. And on the right-hand side, you can see that we continue to be underweight long-term bonds, overweight short-term bonds, leaving the overall portfolio at about the interest rate sensitivity of the Barclays aggregate. We have some updated charts. I'm going to go through them quickly because I know we've got a lot to look at here, but you may want to go back over this. If you turn to page 18, this is volatility, the S&P 500 implied volatility, going all the way through September 8th. And we went ahead and ran these charts right up to recent times, so you can see we had a lot of rock and roll in the markets in August and early September, and you can see the volatility spiking up almost to the 40 level versus the 10, 15 level that had been in it some time, and it's fallen back to about 25. This, of course, was driven by all the concerns and uncertainty in China over the August period. The Chinese government has behaved in an unexpected and unusual fashion with regard to their currency policy, dropping the yuan exchange rate suddenly. Several attempts to prop up their stock market, the last of which is when using central money didn't work, they're rounding up the folks that we're selling, and including the nation's largest security dealers. So this doesn't engender a lot of confidence, and there's been a lot of concern about China and the Chinese markets. They've calmed things down over the past couple of weeks, saying that they're not trying to engineer a new currency policy, and that has settled the markets down a bit. But I would look for volatility to be back, and that is not all bad news, because we are starting to get paid for taking risk again. We can see this on page 21 and 22. The downside is the markets fell, and the assets that we held were impacted. The upside is we make new contributions to the fund and put them in risky assets. We're beginning to see better spreads in risky assets. You can see this on the top panel on page 21. High yield spreads have headed upwards and are now getting back to more typical levels at 544. Even the corporate investment grade spreads have risen, and of course on the bottom you can see that price earnings ratios in the stock market have improved markedly during that time. We have a rebalancing policy, so as asset classes are become weak, we buy them. As asset classes are strong, we sell them, so that we stay on balance over time. And as the market is volatile and choppy in a directionless pattern, this will benefit us, this rebalancing policy. So that's where we stand at the end of July. We have two special entrees here for you in the public session. One is corporate governance education session that will be Mike Garland. He'll be up first, and then Barry and his team will take us through a primer on asset allocation. If there are any questions on July? If not, we can move on to those presentations. Okay, why don't we start with Mike Garland?
Good morning. My colleague Scott Trace will be handing out a presentation. I'll do an abbreviated version of the presentation. To make sure everybody has it.
Take it easy. Las Vegas dealer.
Broken the bank this year.
Great. So I really just want to give a brief overview of the corporate governance program, why we exist and what we do. I'm not going to report on initiatives. I will be coming to the proxy committee in a month or so to give a report on initiatives. The program is overseen by the proxy committee, and some long-standing trustees on that committee know this material well. Right? It's an opportunity just to make sure other trustees are briefed. So quickly, if you go to slide 1, our first fundamental responsibility is voting proxies for your public equity. So roughly half your portfolio is invested in public equity. I think 70% of that in U.S. public equity. You hold nearly 3,500 U.S. companies, probably close to that amount outside the United States. We have the responsibility to vote annually on election of directors, executive pay, and the proxy votes attached to those plan assets they're considered plan assets, the proxy votes, and must be exercised in the best interest of your participants and beneficiaries, and we do that under policies established by and approved by the proxy committees. In addition to voting proxies, we actively engage portfolio companies through a variety of tools to strengthen corporate governance and promote sustainable business practices. The reason we do that is really a reflection of your time horizon and investment strategy. You are, as you know, long-term owners, and not only because you're thinking, investing a generation down the road, but also because most of your public equities are in index funds. So if you have concerns about a board, a management, a particular business practice of a company, you can't do what some investors do. They call it the Wall Street walk and just sell your shares. So the only way you can protect or create value is to be an active owner. So I call it active ownership as opposed to active management, buying and selling stocks. So we are an active owner, and that program is overseen inside the controller's office. So when we think about our core responsibilities, we're voting proxies, we're engaging your portfolio companies, we also engage with regulators, we collaborate with other institutional investors, and we serve as a resource with regard to other responsible investment activities within the office. We have an 8-member team. We recently hired a senior staff person, Scott Drazel, who's here. I want to introduce the people. Scott ran the corporate governance program at the Amalgamated Bank, and he helps to deepen and broaden our capacity as we're taking on some ambitious work. So we're lucky to have him. I'm just going to jump ahead to slide 4 very quickly to give you a sense of when you think about active ownership and the continuum of the way we engage companies and other investors do. The police fund and the New York systems generally are among the most active institutional investors in the country. We are far to the right on this spectrum. We are among the most active in submitting share owner proposals to companies on a broad set of reforms. We sometimes serve as lead plaintiff in litigation, oppose the election of directors. No one's quite at the place where we're running director candidates, but in part through an initiative that the police and the other New York City funds launched this year, if you go to slide 6, we're moving in that direction. Hope to be able to have that capability in the near to medium term. But we did launch an initiative last fall called the Boardroom Accountability Project, which seeks to go company by company to put in a mechanism whereby substantial long-term owners have the ability to nominate some directors and include those directors on the company proxy. Investors have been fighting for this right since the collapse of Enron as a regulatory reform, and we keep being stymied. So we've decided to go company by company. A year ago, 6 companies in the United States had proxy access as the name of the right on unworkable terms. Today, it's roughly 50, and if you speak to a corporate law firm, they would tell you probably by the end of the year it may be as many as 100. And we aren't responsible for all of those, but it wouldn't really have happened had the New York City funds not launched the initiative in the fall. And then finally, on the last slide, I'm not going to go over it. You can look at it at your leisure, but we do help and help lead various other responsible investment activities. So we help with the responsible contractor policies where boards have those in place, respond to questionnaires and other things that may either come to you, the board, or to other areas of BAM. Happy to take any questions. Is there any questions?
Do you have an idea when the proxy meeting will be?
We'll be reaching out to you shortly, but I'm shooting for early October. Work for you?
Okay. Might have to be later, but we'll see. All right.
Okay. Great. Thank you. Thank you.
Thank you.
So the next item on the agenda is the asset allocation review by SIS. So take it away, SIS.
Thank you.
Good morning. This is not your typical asset allocation review. We've tried to make it both educational and entertaining. Mark Gazelle, who's been working on your fund for the last 15 years, will deliver it. It's designed to give you an idea of the importance of asset allocation and how it works. We will be coming back in subsequent meetings to work on specific police allocation, and we are going through a very rigorous process this year of trying to figure out how to make the most efficient use of the 25% that's available in the basket to help diversify the big stock and bond positions in the fund. With that, I'll turn it over to Mark.
Thank you, Barry. Good morning, everyone. There are 3 modest objectives for this brief presentation. One is to illustrate the relative importance of the asset allocation decision, and 2 is to explain some of the jargon we're going to be using in the process, and 3, we want to touch on some of the major issues that you'll be facing these days so that you can confidently make and defend your decisions. Some of this is going to be a little basic for some of you, but hopefully we've thrown in something for everyone. Format is mostly fun facts, sort of interspersed with some of my interpretations. I'm unlikely to say anything controversial. As Barry said, we're just here to educate and entertain today. That said, my facts are not the only facts, and my interpretations are not the only interpretations, so feel free to interject. I may just nod, just to keep the pace, and nod and continue to keep the pace going, but feel free. Everybody ready? So on page 2, let's imagine you're an investor in 1977. And unfortunately, that's going to be easy for some of us in this room. I was only 15, so my biggest decision at the time was 8-track or cassette. But I did understand that times were hard. Jimmy Carter had just been elected president, or rather, he had just taken office that year, and he had inherited some big structural problems. Anybody want to guess what took the Oscar for Best Picture that year? 1977? Rocky. Deer Hunter was a little late. So Rocky, perfect for the mood of the country, a story of a loser who gets a second chance and becomes a winner. Now, an investor looking back 14 years or so in 1977 would have seen some pretty lackluster returns, as you see here. The two biggest reasons for that is in the late 60s, the deficit financing of the Vietnam War had driven up interest rates, and bond investors in the last half of the 60s actually lost money. The second reason is that in 1973, in October, Egypt and Syria launched a war to retake territory they had lost in '67. The fighting was over by the end of that month, but when the dust had settled, OPEC decided to punish the supporters of Israel, among them America, of course, and we experienced the first oil shock. So from late '73 into spring of '74, oil prices quadrupled. And that was the beginning of the gas lines. I don't know if you remember those. As if that wasn't enough, those were the bad old days for this city's fiscal situation. And I only mention that is because although '73 and '74 were two of the worst years on record for the stock market, '75 was one of the best. And at least one historian credits the resolution to the city's problems as one of the reasons, one of the sparks for that. However, '75 wasn't good enough to offset a decade and a half of trouble. So again, imagine it's '77, you've got a simple portfolio, 60% S&P 500 index, and 40% long-term corporate bonds. Pretty conservative. All right, and you're beginning to think that the bad times can't go on forever, and you decide to take a little more risk. Let's turn to page 3. You may have wondered why I chose to start the record in '63. In '63, Ned Johnson of Fidelity started what is perhaps to become the most famous mutual fund ever, which is Fidelity Magellan. And he ran it until '77. And you may have heard, let's say that you'd heard of the fund, and you'd seen it had a fantastic track record under Johnson, but the hitch was they were changing managers. And there's a new guy named Peter Lynch. So you consider maybe taking 5% of your stock index fund and putting it into Magellan. On the other hand, you like what Jack Bogle has to say over at Vanguard about keeping fees low and the difficulty of active management beating the indexes long term. So on page 4, let's look at the outcome of these two choices. As you may suspect, the 13 years that Peter Lynch ran Magellan, you would have done very well indeed. What you may not know is you would have done very well with the other choices as well, not taking any more risk or not increasing your stock market exposure. As you can see, 13.5% if you'd have done nothing, but year over year, just a 5% allocation of Magellan would have added 70 basis points. And a little more stocks would have added 30. Now, I put risk in quotes because we're going to get a little more into what we mean by that as an general. point here is that the active management only increased risk by 20 basis points, whereas the 5% more exposure to the stock market index increased risk by 40 basis points per year. Now on page 5, we're showing you two parts of this story. So between 77 and 81, actually, general investment returns were not that good. But that was the time when Lynch was shooting the lights out, adding 1.2% per year, but also adding considerably to the total fund risk at 40 basis points. After 81, his style was still working, but the results were less spectacular. But on the other hand, he added little additional risk to the total fund. Interestingly enough, the risk added by the additional 5% in the S&P 500 index was the same in both periods, essentially the same, 30 basis points and 40 basis points. On the next page, I just want to make a side point about what happened in 81. That was the year that the Fed under Paul Volcker decided to crush inflation by jacking up short-term interest rates. And you can see after that how stocks took off. What's also interesting is you'll notice that bonds took off and kept going. You can see that because the slope after that vertical line is about the same, you're getting about as much growth out of bonds as after stocks, as out of stocks. Now, you could call this, and a lot of people do, a 30-year bull market in bonds, but it looks more like a structural change to me. It's almost as if we didn't have the same financial system after 81. So back to our story on page 7. After Peter Lynch left Magellan in 1990, neither the increased active risk by staying in the Magellan Fund or the increased risk, asset class risk by having the extra 5% in stocks would have increased your return by much, and it rounds to 0 in this case. But again, what we're interested in at this point is how much risk do these things add. The active management continued to add just a little more risk. The asset class exposure added about the same, 50 basis points of risk to the total fund. In both cases, or in all cases, you still would have done very well over those 25 years with a 9.3% annualized return. The moral of this story is on the next page. Note that in all the periods we examined, excuse me, let me back up a bit. The punchline is that the effect of the asset allocation decision on risk tends to be both bigger and more predictable than the effect of the manager selection decision. If you look on that far right-hand column, that risk created by the additional asset class exposure was about the same in all the periods we examined, whereas the active risk tended to vary quite a bit, but it was smaller. So I'd like to pause here if there are any questions or comments. So what exactly do we mean by risk? As you may know, investment risk is most commonly expressed as standard deviation. Standard deviation is essentially an average difference from an average. We figure out the average return over time, and we subtract that from each period's return. We multiply each difference by itself for reasons I'm not going to get into. But we take the average of those square differences, an average of the difference from the average. Another name for average is mean, and you're going to hear me use that, but annualized return is also sometimes called a geometric mean, but I'm not going to do that to you. I'm just going to say annualized return. Just remember, when I say mean, I mean average. On the next page, we've stacked up the annual returns, the S&P 500 for the last 89 years. And you can see on the left there, the worst years, and 2008 was among them. The mean, or annualized return of this 89-year period, was 10%. When we calculate the standard deviation on the next page, we can use that as a sort of measuring stick. So in this case, you can say that 2008 was more than a 2 standard deviation event. And then next on page 12, we throw in a good proportion of bonds. So we're looking at, again, at the same 100% stock investment on top, and on the bottom is a 60-40 portfolio, 60% stocks, 40% bonds. You can see there's a dramatic reduction in risk. But of course, you have to give up a little bit of return. And please turn to page 13. Now, let's divide up the same years between those years when the bond returns were below average and those years when the bond returns were above. And then stack them up as before according to stock return. So you can see where I've circled that there were plenty of years when good stock returns offset poor bond returns, and vice versa. On page 14, we're going to show you another way to see it. So we're going to plot stock return on the vertical and bond return on the horizontal. And there's 2008, a low stock return and a good bond return. On the next page, we plot all 89 years, and you can see that they're all over the place. And we use a number to express that. And the number is called correlation. So in this case, the correlation is 0.1. Correlation will range between -1 and 1. And for the purpose of minimizing risk in a portfolio, of course, low correlation is better. On the next page is simply an example of high correlation. In this case, the bond returns are again on the horizontal, and the 5-year treasury return is on the vertical.
For bond return, are you using ag, just the ag as the proxy for the bond returns as a whole, or?
Throughout, until we get to the end, it's Evanston's long-term corporate bonds. So that's what high correlation looks like, 0.9. Okay, on page 17, we start to ask, why is low correlation good? What are its effects? So let's plot our portfolio annual return over the whole 89-year period on the vertical axis and risk on the horizontal axis. So there's our 10% stock return and on the right, and your 6% bond return on the left. Everybody with me? Now, you might think that mixed portfolios of the stocks and the bonds would lie on a straight line between them, and you'd be mistaken. And you can flip past page 18 to right to page 19. This is actually what would have happened had you owned those portfolios over those 89 years. So on the left, you can see that just by adding 10% of the most risky asset, you would actually experience less risk than had you been 100% invested in the least risky asset. Now, this is pretty much magic. I mean, it's as close to a free lunch in economics as you can get, and it earned Harry Markowitz a Nobel Prize. He developed a mathematical technique for keeping your portfolio on the line, no matter how many asset classes. You know, with much refinement, we use the same basic techniques today. So on page 20, we've listed what we've just talked about. These are the 3 main ingredients for asset allocation: mean or average return, standard deviation or risk, and correlation, which is an indication of the risk reduction you can get by combining pairs of asset classes. But we're not really good to go, so on the next page, we point that out. Historical numbers are only a useful guide to future numbers, and that's where it gets challenging. There's almost certainly the biggest thing to consider these days is on the next page. Recall that bond yield is the return you get if you buy today and hold to maturity. For that reason, we consider current yields, we and most consultants, to be a pretty good indicator of future bond returns. And as you're doubtless aware, bond yields today are very low. Here's the comparison with historical returns. So long-term corporate bonds at 6%. When I say today's yields, these are actually from May when we last reset our expectations. So they should be a little higher today. 4% 4.2% for long-term corporate bonds, but look at treasuries, they're all the way down there at 1.3% on 5 years. Next slide, please, 23. It gets worse, because expected stock return is often built up from the bond yield. Using the historical extra return or premium that you earn by being a stockholder. So because Treasury and corporate yields have diverged so much, we're going to consider both premiums here. So there's your 10.1% long-term stock return and your 6% bond return. So stocks earned you 4% more. They earned you 4.8% more than intermediate treasuries. On the next page, we see what happens when you apply those historical premiums to today's yield. So if we take that 4% premium and add it back to the 4.2%, we might think that stocks in the future, or in the intermediate future, are going to return 8.2%. However, if you add the 4.8% to the 1.3% treasury yields, you only get a stock return of 6.1%. Now, that's pretty far off from our 10% return that we saw over the 89-year period. Now, the process by which we develop our expected return for U.S. large cap stocks is a bit more sophisticated than that. And we'll discuss that in future meetings. But it's worth noting here that our current number of 7.1% happens to split the difference. And you can see that on the next page, page 25. And what that means is that, for purposes of comparison of comparing us with other consultants, our premium to long-term credits is actually lower than historical, 2.9%. However, our premium relative to treasuries is quite a bit higher than historical, 5.8% versus 4.8%. So something to keep in mind as we go forward. Page 26. As for our expected return on core bonds, they are based on the yield to the Barclays Agg, and that stood at 2.1% last May. In recent years, however, we've adjusted that upward to account for clients who've been tilting away from treasuries. So our long-term expected return for core bonds is currently 2.5%. So to bring it around, first full circle, let's go back to our simple 60-40 portfolio and apply these forward-looking numbers. We do that on page 27. Those are pretty low, so 5.6% for 60-40 stock and bond portfolio, 65-35, 5.8%. Considerably less than the almost 9% that you would have gotten over the last 89 years. And then I have one final point to make on the next page. Although we haven't yet detailed our expectations for all the asset classes in the police fund yet, we have calculated for you on the right there the expected return for the total fund. You can see by that there's a significant amount of return to risk coming from asset classes other than public equity and bond managers. And that's pretty much what we have today. In subsequent meetings, we're going to go into more detail on asset class expectations, and we're going to explore where you might want to take a little more or less asset class risk. So does anyone have any questions or comments?
So the conclusion is we're looking for that Nobel Prize territory.
Thank you.
Thank you very much, guys. As you know, we're working with SIS and all the consultants to do an asset class review and look at what the changes in asset allocation might get us a little bit more to the left and up into that Nobel Prize winning territory that these guys were talking about. It's an iterative process. We're working with SIS and the other 4 consultants, and we'll be back to you in coming months to discuss it in more length. But it's been a very productive discussion thus far. Okay, this concludes our public session for the pension fund.
So I make a motion that we leave the public session for the pension fund and go into public session of the police officers variable supplement fund.
Second. All right.
So I would submit to you the officers first. The officers supplemental fund review. I don't know if you'd like to go through it or just accept it as.
I will accept it for what it is, which is a accurate assessment of where we are with the police officers variable supplement fund. And what is currently the amount in there, $1.5 billion in the fund, which means we're doing pretty well. So.
Alrighty, and that is, correct, if you look on page 8, yeah, that's the amount 1.462 billion, Joe.
Give or take a couple hundred.
It was 2.99% net of fees, 55 basis points ahead of the benchmark for the quarter.
Thank you. So I make a motion that we leave the public agenda for police officers variable supplement fund.
I have a second.
I'll make a motion that we go into the public session for the police superior officers variable supplement fund.
Second.
Last meeting was very short.
Okay, we have for you a review as well of the police officers variable supplement fund.
Superior officers.
I'm sorry, superior officers. What is it? It's $702 million in the fund at the end of the fiscal year, 12.32% return during the period. Any questions?
Scott, I do have one question. I was looking at the asset allocation between the superior officers and the police officers in that, you know, they have similar asset allocations, but, you know, different returns. Is that a timing issue? Like a cash kind of timing issue?
I believe so.
Okay.
I believe it had to do with the skim and when it came in.
Okay.
And, you know, hitting the market.
At the right time
just the right
for
time.
the superior officer?
Correct.
Okay, perfect. Thank you.
And we can go a 3-hour meeting on how the skim works. So.
Please no.
No, that's on nothing. Offline meeting, of course. So I make a
We'll make a motion, we can, we accept the report as written, and that we make a motion to adjourn.
Second.
So I make a motion that we leave the police officers, we leave the, he already did.
No, he has to make the motion because it's his.
I can't, I'm not on that.
Yes.
You gotta do it.
You made a motion
To adjourn.
To leave.
to exit, to go.
exit.
He just
Okay.
did that.
And we
You need a
second.
need a second.
And then make a motion that we go into executive session of police officers, of the pension fund. So now we're in executive session.
Okay. Thank you.
Yeah.